What if I told you there's a company with an incredible 53-year streak of dividend increases? A company that Warren Buffett himself would probably nod at and say, yep, that's a wonderful business. Today, we're taking a deep dive into an iconic consumer products giant. It's quietly undergoing this massive strategic transformation. We're going to figure out how it really makes money, dissect its hidden strengths, and, ultimately see if it's trading at a compelling value for you. Welcome to the Deep Dive. This is the show that cuts through the noise, gets straight to the important stuff from your sources. Today, you've asked us to unpack the investment case for Kimberly-Clark Corporation, ticker symbol KMB. We're looking at an in-depth value investing analysis. All the data we're using is tied to September 9, 2025, and the share price we're working with is $128.98. Our mission: to understand this business like a seasoned investor, but without drowning in information. And just before we jump in, a quick note: this deep dive is powered by Stock Analytics AI. If you like what you hear, think about subscribing. It's $4.99 a month for priority deep dives on S&P 500 stocks.
Over the next few months, we're actually covering all of the S&P 500 companies, and members get exclusive priority access, so worth checking out. Or, hey, if you just want a one-off deep dive on a specific stock that you pick, just drop us a super thanks. Okay, let's get into it. Right, we're kicking off with part 1, the foundation of business, management, and financials. Let's start at the very beginning then. Chapter 1, understanding the business, the Kimberly-Clark enterprise. So what exactly is Kimberly-Clark, and why is it seen as such a classic, understandable business?
Well, it's pretty remarkable, really. KMB was founded way back in 1872, and it's kept this simple, essential focus. It's all about paper-based consumer products, things for daily health, hygiene, stuff billions of people use globally. Operationally, they break it down into 3 main areas, although one is changing pretty dramatically right now.
Okay, tell us more about those segments. Is there one that's kind of the main engine, and what's this transformation you mentioned?
Absolutely. So the core segments are personal care, consumer tissue, and KC Professional, or KCP. Now, what's really compelling, especially looking at fiscal year 2025 projections, is personal care. Think Huggies, Kotex, Depend, those kinds of brands. That segment is projected to be the huge revenue driver, estimated $10 billion, which is like 63% of total revenues. Then you've got consumer tissue Kleenex, Scott, Cottonelle forecast for about $6.0 billion. That's 36%. But the real story, the big shift, is KCP. That's the workplace hygiene stuff. It's undergoing this dramatic strategic pivot. Projected revenue is set to decrease by an astonishing 95%.
95%?
Yeah.
Whoa.
Yeah, from $3.2 billion in 2024 down to just $159 million in 2025.
Okay, wait, a 95% decrease. That sounds like, well, like an operational collapse for most companies. That'd be a huge red flag. What's the thinking behind that? It can't just be falling off a cliff, right?
No, not at all. It's actually very calculated, you might even say audacious, strategic move. The real insight here isn't just trimming fat, it's a major bet by management. Their explicit goal is to transform KMB into a pure-play personal care and wellness company. That's the phrase they use. So this involves things like a joint venture with Suzano for their international tissue and professional businesses, and getting out of private label diapers entirely. The whole idea is to shed the lower margin, maybe more volatile segments, and really laser focus on the higher margin, brand-driven personal care division. They believe that's how they enhance long-term profitability and ultimately deliver more shareholder value. It's like they're fundamentally changing their identity.
Right, shedding the less profitable parts to focus on the core strengths. That makes strategic sense. So with this focus, those iconic brands become even more central to their value, don't they? How strong is that brand portfolio?
It's absolutely the bedrock. I mean, KMB owns 9 leading global brands that each pull in over $1 billion in annual sales. We're talking Huggies, Kleenex, Scott, Kotex, Cottonelle, Depend, Pull-Ups, names everyone knows. Their products are used by nearly 1/4 of the world's population. Think about that. And they hold the number 1 or number 2 market share spot in something like 70 to 80 countries. They back this up with serious marketing too, like $410 million just on Huggies in 2023. It creates that trust, When you need diapers at 2 a.m., you grab the brand you rely on, not necessarily the cheapest. That's KMB's strength.
That is an incredible global footprint. So how do they actually manage to get these essential products out to so many people in nearly 200 countries? What's the logistics like?
Yeah, the scale is just vast. They reach over 175 countries. They have 94 manufacturing facilities spread across 39 countries. Revenue-wise, North America is key, making up about 55% of their net sales. Distribution is multi-channel, Primarily, yeah, it's traditional retail supermarkets like Kroger, Albertsons, the big guys. But e-commerce is growing fast. It's now over 25% of their consumer sales. That's $1.2 billion a year just from platforms like Amazon.com. And they're also building out their direct-to-consumer channel, which is pulling in around $360 million annually. So a really diversified approach to reach the customer.
Okay, we've got powerful brands, global reach, but how do they defend that position? This brings us nicely to Chapter 2, the economic moat. Assessing competitive durability. What makes KMB's competitive moat so strong? How do they keep competitors out?
Well, their most formidable advantage, hands down, is those intangible assets, the globally recognized brands we just talked about. Decades of building trust lets them command premium pricing, get better shelf space. It's huge. And this brand power isn't static. They reinforce it constantly with innovation. They hold over 3,200 patents worldwide. Plus, they invest significantly in R&D, about $487 million in 2023. So it's not just the name, it's the perceived quality and reliability people pay for.
Right, the brands are huge. But is that it? Is the moat just about brands, or are there other factors, maybe less obvious ones, reinforcing their position?
Oh, there's definitely more to it. If you step back and look at the bigger picture, their massive operational scale gives them significant cost advantages. Running 94 facilities globally, that gives them immense purchasing power. They spend $2.1 billion a year on pulp, $1.5 billion on petroleum-based materials. They get better unit costs than smaller players can hope for. And on top of that, their entrenched distribution network, those long-standing relationships with giants like Walmart and Costco, that's a massive barrier for anyone trying to break in. Imagine trying to replicate that logistical web and those retail partnerships from scratch. It's almost impossible.
Okay, so a strong defense. But they're up against some serious players, right? You mentioned P&G earlier. How impenetrable is this moat, really? Where could competitors maybe find a chink in the armor?
Yeah, that's the critical question for any investor, isn't it? The industry is definitely dominated by giants, P&G, Unilever, Colgate-Palmolive. These are behemoths. And P&G, for instance, their market cap and revenue dwarf KMB's. We're talking $368 billion versus $43 billion market cap, $84 billion versus $20 billion revenue, roughly. Big difference. But interestingly, KMB really holds its own. Customer surveys actually rank KMB #1 in pricing score and customer service score against its peers. Pretty impressive. And #3 in product quality. And if you look at valuation, KMB's PE ratio right now is around 17.2x. That's significantly lower than P&G's 24.1x or Colgate-Palmolive's 23.6x. That gap, that difference in valuation, suggests the market might be perhaps underestimating KMB's focused strategy or its pricing power right now.
That's interesting. Okay, Buffett always says you need a wonderful business and great management. So let's talk about that. Chapter 3, management evaluation, stewardship, and strategy. Who's actually running the show at Kimberly-Clark, and what's their strategic vision?
Right. The person at the helm since 2019 is Chairman and CEO Michael D. Shu. He leads a pretty seasoned team, people with backgrounds from big names like PepsiCo, Toyota, solid experience there. His tenure has really been defined by this major strategic overhaul, the Powering Care initiative, which they formally kicked off in 2024. He seems to be about decisive action, not just, slow, incremental changes.
Okay, Powering Care. What exactly does that involve? What are the main components?
It really boils down to 3 core pillars.
Yeah.
First, accelerating pioneering innovation. Second, optimizing their margin structure, basically, cutting costs smartly. And third, rewiring the organization for better efficiency. And they've made some bold moves already, like acquiring things that's the reusable period products company, exiting the private label diaper business, as we mentioned, and forming that big Suzano joint venture. Early signs are actually quite promising. Their 2024 performance apparently exceeded the new growth targets they set. And management's aiming high. They're targeting a gross margin of at least 40% and an operating profit margin between 18% and 20% by the end of the decade.
Those are definitely ambitious targets, especially getting gross margins over 40%. What are the big hurdles to achieving that? And what if they don't quite hit them? And how does all this ambition then translate into how they allocate capital? How do they use their cash?
Yeah, hitting those targets takes superb execution, no doubt, especially with competition and volatile raw material costs. If they miss, that would pressure the stock. But the momentum seems positive for now. And connecting this to the bigger picture, their capital allocation strategy seems very clear and shareholder-friendly. They are reinvesting heavily, planning over $2 billion for their North American business in the next 5 years. That's for expanding manufacturing, upgrading the supply chain. But they're keeping overall capital expenditures disciplined, aiming for 4% to 5% of net sales. And crucially, KMB is a dividend aristocrat. You mentioned the 53 years. That's 53 consecutive years of increasing the dividend. The current yield is around 3.9%. Plus, they consistently buy back shares $864 million worth in 2024 to return excess cash. That 53-year dividend streak isn't just a number. It really speaks volumes about management's long-term focus and consistency.
Okay, that consistency is impressive. What about insider trading? Does management buying or selling their own stock give us any clues about their confidence? A kind of gut check. That's always a good gut check, yeah. Looking over the last 12 months, there has been more selling than buying, about 35 sell transactions versus 9 buys. But digging into it, a lot of those sales seem tied to executive compensation programs, stock options vesting, things like that. Standard stuff, it looks more routine than like a big red flag signaling a lack of confidence. The long-term strategy seems to be the focus rather than short-term trading signals.
All right, makes sense. Let's shift gears now to part 2, deepening the dive: financial health, risks, and valuation. So I've looked at the business, the brands, the management. Now let's really crunch the numbers. Is KMB a financially sound company? Time for Chapter 4, financial health analysis, a 10-year review. What's the financial story been over the last decade or so? Is it growth? Profitability? What stands out? Well, KMB isn't really a story of rapid top-line growth. Revenue's been relatively stable. The 5-year cumulative growth is about 8.7%. Steady, not spectacular. But the real story, the engine of their financial health lately, has been profitability improvement. Big time. Earnings per share, EPS, showed really robust growth, jumping 44.9% to $7.55 in 2024. And crucially, that margin expansion we talked about. After hitting a 5-year low of 30.8% back in 2022, their gross margin bounced back strongly to 36.5% in 2024. And remember, they're aiming for 40% plus series. This really signals that their powering care strategy is starting to bite. It's genuinely taking hold.
Okay, so making more profit from the sales they already have, that's key. How efficiently are they actually using their capital, their investments, to generate these profits?
Yeah, their efficiency is actually quite remarkable when you look at the numbers. KMB's return on invested capital, or ROIC, for the last 12 months was an impressive 27.9%, and the 5-year average is strong too at 25.4%. This consistently high ROIC, that's a classic sign of a strong economic moat and, frankly, effective management. Now, you might see their return on equity, ROE, looking sky high, like over 200%. But that's largely distorted because their shareholder equity base is very thin due to how their capital structure is set up. So ROIC is definitely the more reliable metric here for judging their operational effectiveness.
That ROIC is impressive. But you mentioned high leverage earlier, that debt-to-equity ratio around 5.19x. How much of that strong ROIC is down to pure operational skill versus, financial leverage just amplifying returns on a smaller equity base? And how solid is that balance sheet overall?
That's a sharp point. Leverage certainly plays a role, no question. But even if you try to adjust for the capital structure, the consistently high ROIC still points to a fundamentally strong underlying business. It's not just leverage. Regarding the balance sheet, yeah, it is characterized by high leverage. That 5.19x debt to equity is high. Though, importantly, it's down significantly from where it was 5 years ago. It was 16.4x then. So that's a positive trend. They're actively managing it down. And despite the leverage level, the debt seems well managed. Their interest coverage ratio is very healthy at 13.7x. They can easily cover their interest payments. Their current ratio is 0.77, which is below 1.0. But that's actually not unusual for stable consumer packaged goods companies like KMB. They have predictable cash flows, efficient inventory management. They don't need to hold tons of excess cash or inventory. It speaks to their efficiency in a way.
Right. Okay. And bottom line, how much actual cash does this whole operation generate? Free cash flow.
They are a powerful cash machine. For fiscal year 2024, they generated $3.164 billion in free cash flow. That was a 4.7% increase from the year before, and it actually surpassed management's own long-term target of $2 billion a year. This robust free cash flow is really the lifeblood. It's what fuels their investments, sustains that amazing dividend, and allows for those consistent share buybacks.
Okay, sounds solid financially. But no investment is risk-free. For all of KMB's strengths, what are the potential bumps in the road, the what could go wrong scenarios for you as a potential investor? Let's cover Chapter 5, risk assessment, identifying potential headwinds.
Yeah, absolutely. For you thinking long-term about KMB, there are several key risks to keep a close eye on. First, Raw material price volatility. That's a big one. They rely heavily on pulp, petroleum-based stuff. Prices can swing wildly and impact margins. Second, intense competition. We've talked about P&G and the others. That's constant pressure. Plus, you've got growing private label brands competing hard on price. Third, slowing category growth in their mature markets like North America. That could limit how much they can expand just by the market growing. They'd have to rely more on taking share.
And with that huge global footprint, I bet international factors come into play too. Currency swings, maybe?
Oh, definitely. If you connect this to the bigger picture, foreign exchange fluctuations are a definite risk. About 45% of their net sales are international. So a strong U.S. dollar can hurt reported results when they convert foreign earnings back. And volatility in, say, hyperinflationary economies can also impact things. And finally, something more recent. The potential impact of 2025 U.S. tariffs creates uncertainty. While tariffs might not be directly on KMB's products, they can disrupt global supply chains. That can increase costs for logistics, transport, packaging, and maybe even soften overall consumer demand if things get expensive.
Okay, those are significant risks to monitor. What about market sentiment? Are short sellers, the folks betting against the stock, seeing major problems ahead?
It's worth looking at the short interest, yeah. As of early September 2025, it's around 6.03 million shares shorted. That's about 1.82% of the float. Generally, that's not considered particularly high. It doesn't suggest widespread bearish conviction or that the market thinks it's heading for a big fall. It's pretty typical for a large, mature company like this. So not a major red flag for a long-term investor. It's definitely not a stock the market is heavily betting against right now.
Good to know. All right, let's get to the crux of it. Chapter 6. Valuation. Determining intrinsic value. This is the big question for anyone considering investment. Is KMB a good buy at its current price, around $128.98? How do we figure out what it's actually worth?
Yeah, the million-dollar question, or rather the 129 question. A good starting point is the price-to-earnings ratio, the PE. KMB's current trailing 12 months PE is about 17.6x. Now, what's quite telling here is that this is below its own recent history. Its 3-year average PE was 21.9x, and its 5-year average was 22.2x. And importantly, compared to its peers, it's significantly lower. The average PE for similar companies is around 25.8x. Even P&G is higher at 24.1x. So this comparison suggests the market is currently assigning a more conservative valuation to KMB right now relative to its own track record and its rivals. Could be an opportunity there.
Okay, so relative to history and peers, it looks, well, relatively inexpensive. But what about a more fundamental intrinsic value calculation, something like a discounted cash flow model? What does that tell us?
Right. Moving beyond relative valuation. If we run a discounted cash flow, or DCF analysis, which tries to estimate all the future cash flows, the business will generate and discount them back to today's value. KMB's intrinsic value comes out at approximately $150 per share. Now, that's based on forecasting their cash flows growing steadily from about $2.12 billion in 2026 up to $2.39 billion in 2035. And it uses a discount rate of 6.8%. That's the rate used to bring future cash back to present value, and assumes a 3.1% perpetual growth rate after the forecast period. So yeah, this fundamental method suggests pretty solid upside from the current share price.
And what are the Wall Street analysts saying? The people who follow this stock day in, day out.
Their consensus estimates are generally in the range of $142.47 to $145.76. The overall rating tends to be hold or maybe moderate buy, so it implies a bit of a mixed view, but largely suggests they see it as fairly priced or maybe having some modest upside from where it is now. It lines up reasonably well with our DCF estimate, actually.
Okay, so putting it all together, the current price, the DCF value, the analyst, targets, what does this mean for the margin of safety that cushion investors look for between the price paid and the estimated true worth?
Exactly, the margin of safety. Comparing the current market price of $128.98 to that DCF intrinsic value estimate of around $150, that gives us a margin of safety of roughly 14%. If you compare it to the average analyst target, around $144, the margin of safety is about 11.6%. Now, for a stable, predictable, established business like Kimberly-Clark, a margin of safety in that 10% to 15% range is often considered adequate. It suggests the stock isn't drastically undervalued, not a screaming bargain perhaps, but it is trading at a fair price, maybe with a modest discount baked in. Certainly doesn't look overvalued based on these numbers.
All right, let's wrap this all up then. Time for Chapter 7, Investment Thesis and Conclusion. What's the final Buffett-style verdict on Kimberly-Clark Corp for you, the discerning investor listening today?
Okay, pulling it all together from a long-term value investing lens, KMB definitely has a lot going for it. It's a simple, predictable business, essential products, powerful brands creating that wide economic moat we discussed. Management, led by Michael Su, seems rational, capable. They're clearly executing this powering care strategy to really boost profitability. Their capital allocation looks disciplined and very shareholder-friendly, especially that incredible 53-year streak of dividend increases, plus consistent share buybacks. Financially, it's a highly profitable, cash-generating machine with that strong ROIC. Now, there are risks. Sure, raw material costs, competition, need to keep an eye on those. But the stock itself, at 128.98 cents, seems to be trading at a fair, reasonable valuation. There's a modest margin of safety, and it's below its historical and peer PE multiples.
So for you listening, the investment case here isn't really about finding the next explosive growth stock, is it? It's something quite different.
Exactly. The thesis for Kimberly-Clark isn't high-octane growth. It's much more about steady, compounding value over time. The key driver for future returns, really, will likely be the continued successful execution of that margin expansion strategy and the portfolio optimization focusing on those core high-profit areas. It's kind of a testament to consistency and focused execution in a market that often gets distracted by short-term noise.
So for the long term, patient investor out there, someone may be seeking a reliable, growing stream of dividend income, combined with the potential for some modest capital appreciation from owning a world-class business bought at what looks like a fair price. Kimberly-Clark Corporation seems to present a pretty compelling and fundamentally sound investment case. And maybe a final thought for you to mull over. As KMB continues this strategic pivot, becoming this pure-play personal care and wellness company, how effectively will they balance that focused segment growth against the need to maintain a resilient, globally diversified supply chain, especially in what seems like an increasingly unpredictable world? That's a key challenge to watch. And that wraps up our deep dive into Kimberly-Clark Corp. We really hope you feel a bit more informed now. If you appreciate this analysis, please do like and subscribe to Stock Analytics AI. Remember, members get priority deep dives on all S&P 500 stocks for just 4.99 months, and we are covering all of them over the next few months. Or if you just want a one-off analysis on a company you choose, drop us a super thanks. We appreciate the support. Finally, the important disclaimer. This deep dive was based on research generated by AI and is purely for informational purposes. It is not financial advice. Always conduct your own due diligence and consult with a qualified financial professional before making any investment decisions.